This is a question I get an awful lot. Cryptocurrency, Paul, Bitcoin, what do you think of this? Well, what is it? Well, cryptocurrency is basically a digital form of currency, kind of like the dollar, but it exists solely online. A bunch of zeros and ones out there in cyberspace someplace. It's not governed by a central agency or a bank, and a lot of people actually like that idea that it's not governed by these entities. Now, this is actually stored out there in something called a blockchain, which actually has some use in the banking industry to reduce expenses or potentially reduce expenses in the banking processes, way past what I can get into here. But the idea that the blockchain isn't necessarily a bad thing. Now, if we look at cryptocurrency, the issue comes down to valuation. Is it an investment, is the question I'm often asked. One of the guys I studied under who won the Nobel for economics basically said this: for an investment to be an investment, it has to have a cost of capital. What on earth does that mean? What we're looking at here is somebody paying you to use your money? Now, if we think of common investments, we'll take a couple examples and look at how this exists in the world for common investments. So if we look at, let's say, the value of a bond. Let's say that the bond pays $30 per year and it has a 3% interest rate. Well, what would I have to pay to buy that bond that pays $30 a year with a 3% interest rate? Well, the answer is pretty simply $1,000. That's what it's worth. I can tell you what that bond is worth. How about a stock that has $1 billion of earning? Let's say it's a value company, and value companies traditionally sell for about 10 times earnings. Let's say that this company has $1 billion of earnings. If I want to buy the whole company, what do I have to pay to buy the whole company? Well, this is pretty easy as well. $10 billion, 10 times earnings. Let's say I'm looking at a piece of real estate, a little bit more complicated as far as figuring this out, the math on this, but let's say that we figure up that after expenses, that real estate typically, let's say it nets about 7% is what the rent that I get after all my expenses. And let's say I've got this piece of property that has, let's say, a $14,000 a year rental payments coming in after expenses. What's the whole place worth if I want to buy it? Well, the answer would be 7% of $200,000 equals $14,000. I know what it's worth. Now, let's talk about Bitcoin. What's it worth? What's the value of it? Well, I don't know. Why? Because we don't get interest, we don't get earnings, we don't get dividends, we don't get rent, we don't get any of those things with Bitcoin. What's it really worth? Whatever you will pay for it. Supply and demand actually drive what it's worth. And the question is this: do you really want your savings depending solely on somebody else's demand for one good? Are you really wanting to just have your retirement or a big portion of it just based solely on the idea that somebody might pay more for what you own as far as Bitcoin is concerned than what you paid for it? It's a gamble at best. Matter of fact, Burton Malkiel, Princeton professor, wrote a book called The Random Walk Down Wall Street. And he talked about various fads throughout history and talked about how investors do get pulled in by these things on a regular basis. He gave the example of the tulip bulb craze. People were paying a lot of money for what? Tulip bulbs, until they realized, oh my goodness, this is crazy. What are we doing? And then you had the South Sea bubble. Sir Isaac Newton, one of the most brilliant men to have ever lived, got pulled in, and he said, I can't figure out the madness of crowds. This is crazy. He lost his net worth, a lot of his wealth, most of his wealth, investing in this very thing right here. Pure speculation. Then you have the tronics boom in the 1960s that Malkiel points out, where all you had to do is put the suffix tronics at the end of a stock name and you'd increase the value of the company. You didn't have to do anything to the company to make it worth more, which is crazy. Then in the 70s, you had the blue chip boom. You had these wonderful companies that the Nifty 50, they called them. And people were all excited about these Nifty 50 stocks that you needed to own, and they ended up being some of the worst investments going forward. And those were real investments in that particular case. Then you had 90s, the dot-com bubble. People got pulled in by that. And you may remember the real estate bubble in the 2000s. And then 2010, and now it's crypto and meme stocks. that people are getting all excited about. And the point I want you to get is this: it's always something. We're always getting pulled in by something that seems exciting, seems to be the get-rich-quick scheme of the day, or some way that I can make more money, or I can look really, really smart at parties. The reality is this: Bitcoin is a speculative asset. And lots of people are going to be hurt, says the street, in 2024. As it reaches new highs, nobody will know when and how far it will come crashing down, was another quote. Bitcoin is a terrible currency to use. I mean, who on earth wants to go and buy or sell something with a currency that can go up $2,000 in a single day or down $2,000 in a single day? Matter of fact, Elon Musk talked about taking cryptocurrency or Bitcoin in exchange for Teslas. And when he realized how volatile it was, he said, forget it, that's crazy. I'm not going to sell you this Tesla for a Bitcoin just to have Bitcoin potentially drop in value, and then I've given you a car of real value in exchange for something that doesn't have value. Not a good idea as a business person. So if we look at the Wall Street Journal, they actually wanted to figure out how this stuff worked, and they came up with their own cryptocurrency just to see how it worked, and they found out it was pretty easy to create your own cryptocurrency. Now, Bitcoin has previously been considered a hedge against stock market risk. In other words, it can offset some of the risk, offset it in your investment portfolio. But you know what's been happening recently? In recent years, it's been moving with the stock market. It's not even a hedge against risk in the stock market. So what happens here is you have this legislation that comes out, and people think, oh, they're legitimizing crypto. No, they're actually talking about something called a stable coin in this particular instance, which could be used as a substitute for a currency in other countries that don't have strong currencies of their own. It also creates a market for treasuries in the United States, which is actually good for our own interest rates here. So it's not all bad, but it's not what most people are talking about, the types of crypto that they're using as investment assets. So what do you want to do? Well, you want to learn more about investing. Being an investor that is just in the dark about what am I doing, why am I doing it, what should I expect, and how does this all work is not a good idea. Our website, paulwinkler.com, is where you get more education on these topics.